So first is we talked about uh, price currency
Yeah.
versus base currency,
Yeah.
where we said that the quotation of P by B, where P represents the price currency and B represents the base currency. The important thing to understand here is that whatever transactions happen,
Yeah.
whenever we talk about that we buy or sell, is with respect to the base currency. So this
Yeah.
plays a very, very important part. And I would teach you later that this base currency sometimes is also called as foreign currency,
Yeah.
right? So let's say you are a US investor. So
The
your
base
currency would
currency
be,
is called the foreign currency.
yeah, the base currency is also called as foreign currency. The reason why I'm telling you this is, let's say you are a US investor. So your currency is USD, right? And you would be um, putting up your portfolio money in, let's say, different currencies. One is in India, one is in Britain.
Wait, sorry, can you repeat that?
Yeah, I'm saying that when I said price currency versus base currency, a lot of times your base currency will be designated in terms of foreign currencies,
Yeah.
right? And why am I saying so? Is, let's say you are a US investor, your currency would be USD, and let's say you have a portfolio in different countries, right? Let's say in India, in Britain, right? Maybe in Europe somewhere. So the way we put the quotation is USD by INR, USD by GBP, and USD by EUR, right? So these will be your foreign currencies, and these will be this is your domestic currency, your own currency, right? And also it also makes sense because since every transaction of buying and selling will be called in terms of the base currency,
Yeah.
right? So it's good that it comes in denominator so that it just do the right thing. Also, you might see where some of the quotations in, let's say, INR by USD. But before getting into any kind of calculation, it is important that you convert that into USD by INR and then get into any kind of calculation, because whatever calculation that you did of buying and selling should be on the base currency.
Got it.
Okay. Now, next part that we discuss on that day is very important. Is, if I would say, 97 by 98 CAD by USD, right? So we discussed that if I say that I have to buy 1 USD, so the question is if this is bid and if this is ask, and we know that bid is less than ask. Also, we also know from this is that dealers bid buy. It means that dealers will buy at bid and sell at ask, basically keeping the spread, which is the profit. And that's the reason you would always see that for illiquid securities, right, the spread is more, right? Because even when it is illiquid, they do not have much of a sale. So even carrying those securities and buying and selling those securities will be expensive. So even they will keep it, the spread is higher so that they can earn the optimal amount, the spread. Okay. Another thing was, what was I saying? Yeah. So in case I have to buy, let's say 1 USD, it clearly means that I have to give away some CAD.
Yep.
Buying 1 USD is as good as giving them some CAD. So the point is that how would I get to know which number should I give? So remember that you, as a retailer, you will be called as retailer.
Okay.
So you, as a retailer, you will always get less and give more. right? So without any doubt, if you are buying one USD, it means you have to give away CAD. If you're giving away CAD, you should give more. We
Got
give
it.
98 CAD, right?
Hmm.
And if you are buying CAD, right, or maybe let's keep it again in USD. If you are selling USD, if you're
Yeah.
selling USD, then it means that you should receive less. So you should receive 97.
Hmm. Hmm.
Now let's.
Today, this is clearer for some reason.
Is
That
clear?
is, yeah.
Then we actually did a question. FX swap. So we did a question where we looked at the forward quotes, and I said that depending upon what your spot rate is, so if the forward points are 10 and the spot rate is 1.52, then we do not blindly do a
Yes.
1.52 plus 10 by 10,000. We don't do. Rather, we looked at the number of decimals here. So if it is 1.52, we do a 10 by 100, and then that's how we got the forward quote. Right?
Yeah.
Okay. Then we also did one question on offsetting,
Yes.
right? Where we clearly defined that if we start from zero and it's already 30 days and this is like 90 days, then what would be my 60 days of interest rate, basically my FX rate, and then we can calculate the forward rate.
Yep.
And understood how much are we going to give and how much are going to get. Okay. And let me know if you should we do that question again or are we good with
Yeah.
that?
Can we do it again quickly?
So I think if you can just maybe spend 5 minutes max on this one, you would know and will come as a refresher. Are you at least able to start the question?
Yeah. So basically, he sells euro, receives Australian dollars in 90 days. So he's set to receive 10 million into 1.25827 Australian dollars. He then in 30 days, he enters an offsetting position to buy euros, which means he has to give Australian dollars, and then he has to give the ask price because he has to give more. So then he has to buy 10 million into give 10 million into 1.32015. 1.32015 is the 60-day forward point quote. And essentially his gain or loss is basically 1.32015 minus 1.25827 into 10 million. And then to calculate the mark to market, whatever his loss is, he has to basically discount it by 1.2%. This is the annualized rate.
Correct.
1.2% divided by into 60 divided by 60.
Correct. So is it now clear?
Yeah.
You sure we should not do this on the board?
No.
Okay, perfect. And lastly, towards the end of the session, I also spent some time making you understand that a FX swap is not literally a swap where there is no exchange. It's just the rolling over one contract from another.
I actually had a question.
Yeah.
So suppose today, a lot of our transactions that we do, say we invest about $200 million today in.
Can you speak a little louder?
Yeah, yeah,
So a lot of
yeah,
transactions that do is on $200 million.
yeah. Suppose we invest $200 million today, and the FX is 85, right?
Mm-hmm.
And this $200 million obviously is converted into INR and invested today.
Mm-hmm.
And so the question was basically, can we is there any way, so in 5 years' time, that's when we typically exit our investments. Is there any way to kind of mitigate against the risk of FX depreciation?
Totally. Yeah, there are a lot of ways. Lot of ways. So what
Okay.
you're saying is, if I understood your question correctly, so you have USD dollar 200 million, while you want to invest in India
Yeah.
for capital appreciation,
Yeah.
but you want to hedge your currency risk.
Yeah.
Absolutely. So all of these contracts that we are talking about, right, take away your um, take away your risk of currency. And I'm going to teach you even later that there are different ways to hedge currencies. If you are, let's say, this time you are open to only INR, that you can always do you can go long or you can go short a
Yeah.
contract on USD INR, and that's how you can hedge your currency.
Yeah.
But let's say you have invested not just in India, but in
Yeah.
various currencies or various countries, which means you are also getting open to different currencies exposure. In that way, you can also hedge with a basket of currencies, right? So I'm going to teach you all of
Got
those
it.
things later.
Okay.
So even
Yeah.
in you can actually hedge as a basket in which the correlation will be a little lower, but it will be cheaper than hedging every currency individually,
Got it.
right? So it's like this, that you want to watch, let's say, 10 channels, and if you keep paying price for every single channel, some price is, let's say, 5 rupees, some channel is, let's say, 5 rupees, and some channel is, let's say, 7 rupees, some 10 rupees. So you end up paying, let's say, 80 rupees in watching those 10 channels, versus what I can do is I can give you a package which costs 60 rupees, in which you get 8 channels of your choice, or maybe 7 channels of your choice, plus additional 5 channels that you actually never wanted, but they are in the package, right? And then you are able to, since you wanted to watch those 10 channels, you are still satisfied with those 7. You're not, it's not bad, right? So that's how you can save your 20 rupees, and you can still almost get the same happiness, right? The same analogy goes there, where you have 10 currencies, let's say, that you want to hedge. If you're going to keep on hedging every single currency, and then you can imagine that some currencies in themselves are uncorrelated, some are correlated, some are negatively correlated. So one way is that they give you a basket of currencies overall to hedge, in which obviously the correlation will not be literally opposite, which means you will not get 100% hedging, but you will be able to hedge, let's say, 80% of the overall thing, and then you are still exposed 20%, but the cost is too cheaper. So that's another product you could buy and get into it,
Okay.
right? But all of those things are part of your syllabus, so I'm going to cover that.
Yeah.
So we talked about FX swap, and I did mention towards the end that you are rolling over from one contract to another. One thing that I still want to convey here, and I just want to reiterate, if you remember, that let's say there's a 30 days contract. Actually, I should write 30. So there's 30 days contract where you will have to buy 1 million euro. So effectively, when there is a 30th day, you will actually buy 1 million euro. But you realize by 25th of that month that you don't want to buy and you want to get into FX swap, right? So you will, first step is to get away with this part, because now you don't want to buy, right? Now what you can do is on the 28th day, you can sell 1 million euro spot. The reason why I'm using the word spot is very important. This is not just a word, but you can selling euro then and there. And if you know, even for trading that we do, there's a T+2 settlement, right? So when you sell 1 million euro spot, so those 1 million euro will get settled on T+2, which is itself a 30th day. And from the forward contract, you were to buy 1 million euros. So that actually cancels out with the transaction of selling 1 million euros. So you got away with this part first. So there is no more transaction that you need to do. You're done with it. But obviously, you wanted to still get into a contract where you would want to buy 1 million euros. So on the 28th day itself, get into a contract of 30 days to buy 1 million euros. Is that okay?
Yeah.
All right. Last thing we talked about, it was even last time, it was just a refresher. So I would not repeat again. Options and then delta. We said call 0 to 1 and then put 0 to -1 and then absolute term 0 to 1 at ATM 0.5, ITM from 0.5 to 1. Okay? We know all of those things. I think let's just start. So there are a few nomenclatures that we need to understand. So one is, they call it as a domestic currency. One is foreign currency, right?
Yeah.
Now, as I said, a lot of times when you get a quote of P by B, so here B represents foreign currency, and it is always to keep the foreign currency as the base currency as well. And the reason being, then all the transactions that we do in terms of the base currency. One more thing is that is very important. Sometimes it is confusing that sometimes this foreign currency is also called as local currency. While you might think that local is like India ki local, so foreign kaise hui? But no, the point is that where if I'm saying that I want to get exposure to US markets or maybe European markets, and I want to get the return of the European markets, so the European market in itself is the local market return. Right?
Okay, clear. Yeah.
Right? So even that part is local currency, you would say. So I'm saying that there are then two kind of returns that you can expect, right? There would be two kind of returns that you can expect. One is from the local currency, basically the capital appreciation that you would see over there, right? Can I say that that is called as RFC because of the capital appreciation, right? Actually, it is RFC is, yeah, it is right. And then you can also say that because of the currency, there are basically two types of returns. If I'm in India and I'm investing in US, so one thing is from the in the US, one of the return would be from the US capital appreciation, and the
Yep.
second change would be between INR and US FX rate,
Yeah.
right?
Yeah.
Which is called as RFX. Is that okay?
Yeah.
So can I say that overall, my total return domestic currency can be given by 1 plus FRC plus 1 plus RFX,
Mm.
right?
-1.
Yeah, minus 1 obviously, right? So isn't it as good as 1 plus RFX plus RFC plus RFC RFX minus 1,
Yeah.
right?
Yeah.
So this is the exact formula that we need to remember. But again, when it comes to approximation, you would assume that depending upon what these values would be, maybe this could be a little smaller number when you multiply both. So I'm saying the major effect is of the additive effect. So you can say that RDC could be similar to RFC plus RFX. This could be a good approximation. But obviously, the best way to go about that is to just do the final calculation.
Yeah.
Is that okay?
Yeah. Yeah.
All right. Let's try one question. Today's US off, right?
Yes.
It's the Independence Day, isn't it?
Correct. So basically, it's going to be the local currency return, which is 5%.
Okay.
Plus, over here, what's happening is there's depreciation of the USD. So 5 minus the depreciation of the USD. But that, I got some weird answer. So what I did first was I did 1 divided by 1.3. And I did 1.33, 1 divided by 1.339. To get the depreciation rate. That was giving me some only 0.03% difference.
Shall we look at this together?
Yeah.
So one thing, Gaurav, look at this. He is a US-based investor. So one thing is he would want to look at his returns in the local market, which is the euro, and between USD and euro. So can I say that my foreign currency in this case is the euro?
Yeah.
So everything that I want to calculate should be calculated in terms of euro.
Yeah.
So is it right to say that this says the portfolio will increase by 5% in euro?
Yeah.
Which is the right thing. And then you mentioned that USD has depreciated. Why are you concerned about USD here? So when I get to know my capital appreciation, I want to understand my FX return in euro and not USD.
Okay.
Can you now try?
Right. Stupid. Okay. Got it. Basically, it's beneficial for you if euro is increasing because. Yes, so the answer is like 3% plus 5%, 8%.
That's the approximation. And how about actual?
Which is 8.15%.
Sorry?
8.15%.
Okay, great. Okay.
Hmm.
So just remember, and also, although this was related to domestic currency and foreign currency, but again, always remember that speak in terms of the base currency. Okay. अगर ये उल्टा भी होता, let's say they could have given us the quotation in terms of euro by USD, let's say.
I would have to convert it because base is euro.
Yes, individually, and then looked at the quotes. Because what I want to understand is, if I'm a US based investor, I would want everything in USD by something,
Mm.
right? So had it been a euro by USD, I would have then converted into USD by euro and then used it.
Yeah.
And there's another topic, but I would just let you review this because we have covered this already in the last class. Look at this. So they say that the beginning value USD by euro and beginning ending value USD by euro. So this is the same exercise that we did towards the end of the session, where I said that in terms of euro, you can always say that euro in this case has appreciated, right?
Yeah.
From 1.3 to 1.339, it has appreciated. However, and just by looking at this, we can say that if euro has appreciated, USD has depreciated. We can say that.
Yep. Yeah.
But the reversing the sign would not help. If you really want to understand how much USD has appreciated, you will really have to convert the two quotes again and then do the same calculation. Make sense? Look at this.
Makes sense.
So they said, if you see that the currency rate is 3%, which we just calculated here. So it says the USD has not appreciated by 3%. It is not, right? Rather 2.912 जो कि कैसे आया रिवर्स करने के बाद. ठीक है? Something that we tried the last class, that it was 5% versus 6.57, something that we got, right?
Yeah.
Okay. Another thing is that we calculated this part, and I said that we are going to get this much return from the capital appreciation and from the FX. But can I say that this is happening because of USD by euro only? What if I have USD by GBP as well? And I have USD by INR as well, and then I have invested only 40% in this and 30% in this and 30% in this. So isn't it right to say that I can have WIRDC?
Yes.
Right? Which is my total sum of the returns.
Yes.
I would call this as I. Is that okay?
Yeah. Do we solve this or just to
Yeah, absolutely. No, you need to solve this. Is it difficult?
Easier.
Okay.
So I got the answer is 9.12%.
Sorry?
9.12%.
9.1. Total answer, final answer.
Yeah.
No.
No.
Okay, let's go one by one. How about this one? How much return did you get from GBP?
So capital appreciation is 12%. And the FX return is negative 1.96%. So 12% minus negative 1.96% minus 12% into 1.96%.
How much it will come out to be?
That's about 10.275%.
There you're doing something wrong. Let's see. So we know that for a what is the home currency? USD. So USD by GBP we are doing right now. Can I say that our FC is 12%?
Mm-hmm.
Can I say that my beginning value when I'm trying to calculate FX, it is It's not USD, it's US, Euro. Can I say the Euro by GBP is 1.1666
Mm-hmm.
and ending value has been given by 1.1437, right? So can I say
Yeah.
that my FX return has been given by final by initial -1,
Yeah.
right? Okay. Then can I also say that my RDC is been given by 1 plus 12%
Mm-hmm.
and then 1 plus M minus 1
Yeah.
minus 1.
Yeah.
Let's try that. So this is 1.12 and this is effectively 1.1437 by 1.666 minus 1. Let's calculate that.
No, but like, why can't we just do the RFX plus the capital appreciation in the country plus
But
the
that's just the
return from
approximation.
FX?
That no, that's just the approximation.
No, no, no. Return plus
Sorry.
FX plus RFX into RDX.
तो मैंने वही तो किया है. This is 1 plus RFC.
No,
This
I
is
agree.
1 plus.
But like, why is my calculation coming a bit different?
Yeah.
Because
So
like,
so
okay, suppose you do M. Suppose you calculate RFX. Let's just do that.
okay. Let's calculate this. 1 second. 1.1437, 1.1437, and this is 1.1666. Okay. All right. This is
Hmm.
what you got.
Hmm.
And then you do a 1 plus of this. Is that okay?
No, no, no. Let's just not do that. Like, there's just why can't we just do 12% minus 1.96% minus 12% into 1.96%?
What you're trying to do is, sorry, let's just write this. What you're saying is, so what you're saying, RFC, which is 12%,
Mm-hmm.
and then what you want to do?
Basically, minus the RFX.
Y minus plus. So negative sign अपने आप आ जाएगा, ठीक है?
Yeah, I know. Yeah.
Okay, and then
Plus RFC into RFX.
RFC multiply RFX. Okay, this is what you want to do.
Yeah.
ठीक है, this will be fine. Let's do that.
Hmm.
This is as good as what we did, right? This is exactly what it is. You just opened it, which is perfectly okay, and the answer will still be the same. So this is 12%.
Yeah.
How much this is in terms of percentage?
Negative 1.96.
1.96.
Yeah.
Plus this is 12%,
Mm-hmm.
right? And then this is minus 1.96,
Mm-hmm.
right? Okay.
Yeah.
Let's do that. This is 12. This is 1.96. Actually negative. Right. So, and this is gonna be a multiplication of these two. Actually, let's keep this in
Yeah.
decimals. All right.
Yeah.
Now let's just sum these three numbers. Same आ रहा है ना? थोड़ा सा rounding of error आ रहा है between this and this.
Hmm.
The same number, right?
Got it.
ठीक है?
Yeah.
So effectively,
Mm-hmm.
this is, if I calculate just this, overall, well, still is the same. The value will turn out to be somewhere around how much? Around 9.8. Is it right to
9.8%.
say?
Got it.
9.804, 9.803. ठीक है, 9.8. Okay. Let's keep it 9.8.
Yeah.
How about the return from euro? How much did you get?
Yeah, that I got as 5.63.
5.63.
Yeah, so I did 5%.
Yeah, this is right. This is right.
Okay.
So only the last part is then the weighted average.
Yeah, weighted average. So it'll be 1.41. No, yeah, this is 75% into 9.8 and it's 7.35 plus 1.41.
Right.
8.76.
So the reason why I wanted to solve this question is I know you would be able to solve it, but then still, did you just
No.
reciprocate those quotations?
Yeah, I did.
ठीक है, बस वही उसमें check करना था. We talked about return for a while now, that if it is a domestic currency, if it is a foreign currency, how do we go about that? But then when I am getting my RDC, which is my 1 plus RFC multiply 1 plus RFX minus 1, if I can do that, and if I can get that, then when I'm going to get some domestic currency return, it clearly means that I would also be getting some kind of a domestic currency risk, right?
Yeah.
And since you're in level 3, you would know that when it comes to risk, we studied this in CFA level 1 as well, that the basic risk formula is being given by, first of all, it's going to be square. Only the variance are additive, not the standard deviations. Right? And I hope you know that they were always of the form a plus b whole square.
Yeah.
Right? So can I say that this is going to be, let's say, w square RFC basically, and then sigma square RFC. So I'm using weight and then sigma, but then of the foreign currency plus w square RFX sigma square RFX plus 2 WFC WFX sigma FC sigma FX, and then the correlation between RFX and RFC. We understand this part, right?
Yeah.
Now, one thing that is, and you would know as well, then this plays a major role. This plays a major role because think about this, that if my correlation between RFC and RFX is actually negative, basically perfect negative correlation, right? In that case, what happens in that case? This is effectively -1.
Yes.
Basically, this part is multiply -1. Everything else same. On this part, this is going to be -2. Let's say all of this value is 1. So effectively, this is -2.
Sorry. How is that 1? That can't be 1. WFC into WFX can't be 1.
No, I'm saying the correlation between the two is -1.
Yeah. Got it.
So I'm saying keeping everything else as constant, leave all of this as constant for now. So the overall factor will get reduced by -2, 2 into -1. Right? I'm just trying to explain you the effect of correlation. That's about it.
Yeah. So it's like a
Right?
perfect diversification type thing.
Yeah. So I'm saying in that case, you are getting similar return, but at a lower risk.
Yeah.
Because the return component will still be the same, but if the two components are uncorrelated, you can get the same return at a lower risk, versus a plus one is going to magnify the whole thing, right? And you can also imagine that I'm just trying to explain one more thing here. I'm just thinking whether I should explain it now or later. Okay, let me just introduce the topic. Important thing that we also need to consider is that if my FX and FC are positively correlated, think about this. Okay, and just understand this a little deep. If they are correlated, highly correlated, and if you try to hedge, the FX, right? Aren't you actually overall reducing the return of your portfolio?
I don't
Because
understand this.
yeah, I get it that you
Hmm.
okay. Just leave this for now. I'll just
Hmm.
tell you this later. Let's leave that part for now. You understand the formula, right?
Hmm.
Right. I was trying to explain you how my decision of hedging would work in case they are highly correlated versus they are not correlated versus they are negatively correlated. Okay, but I'm going
Got
to
it.
come back to that later. For now, have you understood the formula completely?
That I understood.
And also, is it okay to say that if one of the if my just in case that my RFC is going to be my risk-free return, then can I say that my sigma RDC is being given by sigma FX, sigma RFX 1 plus RFC. And why is that so?
Because the correlation is zero.
Correlation would be 0, yes. And
And
then
you have I don't know this part.
my correlation would be 0, and my RFX is the only risk. This is a risk free, right?
Yeah.
So my RFX will be the only source of risk.
RFX would be the only source of risk.
देखो,
Yes.
right? So
Risk
can I say
free.
that
Yeah.
my this makes sense?
Yeah. 1
Shall
plus
shall we?
RFX. That is.
Yeah. So I'm saying let's just try to redo this. Redo as in use the original formula and see how that this works. In this formula, the correlation is 0,
Yeah.
right? So can I say that my sigma RDC square is being given by W square RFC sigma
Hmm.
square RFC plus W square RFX sigma square RFX. ठीक है? Now what happens is when it comes to now what else can we do here? What else can we do? So when I know, how about my sigma RFC? When my FC is my return, this is a risk-free return. Then how about my sigma RFC?
0, is it?
Is it 0? So if it is 0, okay.
No, I don't know. I just really don't know.
All right. So assume that let's take two currencies, right? In fact, I'm just thinking of giving an example. Just hold on for a second. Just hold on for a second. Okay. So basically, when you so one thing that we need to remember here is that when it is a risk-free, when RFC is a risk-free return, one of the we understand this equation.
Yeah.
Right? We covered that already. Also, it says, look at this. However, the two basic variance formula can be simplified with when the domestic investor holds a single foreign currency. When there are no different weights and there is just one weight, then you can reduce this equation to look at the weight. The weight here is 1. So sigma square RFC plus sigma square RFX plus 2 sigma 1, sigma 2, and then the correlation.
No, so you're saying if the how can the weight be 0, 100%?
So what they are assuming is that you have only one single currency. Basically, you have, let's say you are an Indian investor and you have exposure to only USD. So all the weight that you have exposed to is only USD, right? So what they're saying is that in that case your weight will be 1 because this is a very generic formula, right? But then what they're saying is, let's say you only have exposure to only USD. In that case, this equation will turn out to be keep weight as 1, then sigma square RFC, sigma square RFX, which is capital and the currency, and then the correlation between the two.
Yeah.
Is this clear?
Yeah.
Sure.
Yeah.
Okay. Then it says, obviously, it depends on the sigma, and then it says correlation also matters. Something that we discussed already.
Yeah.
Right? It says that if the correlation between RFC and RFX is negative, the third component of the calculation becomes negative, right? This becomes -2.
Yeah.
I'm using the word -2 because I'm just looking at this factor as -1 multiplied 2.
By 2. Yeah.
Right? And then the correlation measures the interaction between these two. Okay. I was trying to explain this part, but then let's keep it for now that the correlation is positive, right? Then RFC amplified by RFX. Obviously, if the correlation is positive, the volatility will increase. Volatility is what? Risk. So they are saying that if the correlation is positive, the sigma would be higher.
Yes.
Right? Sigma represents volatility.
Yes.
So they say that if the correlation is positive, the sigma is higher. And if the correlation is negative, the sigma is lower, which means the volatility of the return is lower.
Got it.
Is that okay?
Yeah.
Sure about this so far? No confusion?
No confusion.
Okay. And then lastly, it says the variance formula in equation 3, the one that we just studied is equation 3, this one. Right? It says it is only an approximation, but appropriate. It is based on the simple additive. This thing ignores the cross product, right? So obviously we haven't looked at the cross product and we do a simple calculation of the two. And then it says the use of I'm just thinking that is it anything important that I need to make you understand? The number of correlation. Okay, what it's saying is that obviously if it has more than 2 currencies, look at this. Consider the portfolio of 2 foreign assets that has 4 variables. Obviously, then you will have to look at the correlation between A to B, A to C, C to B. Make sense? Right? So it says there will be 6 correlation pairs, right? Obviously, that's not possible. The precise variance calculation would require accurately estimating all the possible correlation pairs. That is considered unrealistic. Okay? So basically, they are trying to tell you that this is just going to be one of the simplest equation, and in which you in case they will give you a question on that, they will give you only one pair. Had there been exposure to various different currencies, you will have to actually calculate a correlation between all of those pairs, which is difficult to calculate and will not be given in the exam. Make sense?
Yeah, makes sense.
And then the lastly says that if RFC is a risk-free return, right? It does also say that it cannot be derived from equation 3. So basically, we cannot really do a plus minus 1 and then get to this equation. But then it says that if one of the return is a foreign risk return, sorry, a risk-free return, right? In that case, the equation only translates to that FX, the sigma of that, multiplied the return of that currency. Right? Which this I was trying to derive that from the previous equation, but then I realized that the book all explicitly says that it cannot be derived from the previous equation. So putting there a 1 or 0 would not help. But you just need to remember that in case one of the return is a risk-free return, then the only exposure that you get is from sigma is the FX from that, and then 1 plus RFC. Right? You can call it one of the equations that you need to remember.
Sigma of RFX.
Yeah. So basically, the return from
sigma of risk-free rate.
Sorry?
Sigma of risk-free rate, is it?
No. So I'm saying the risk rate is obviously 0, already done. So I'm saying the rest part. So I'm saying if you have a risk-free return, then from the forex, from the change in the currency, you will have some kind of sigma.
Yeah.
Right? And then the risk-free return. The only exposure is so there will not be any correlation. So think about this: if you are investing in Cambodia, and Cambodia is giving you a risk-free return, so the only exposure that you will have is between INR to Cambodian currency, and then the return that you get from the Cambodian markets. Understood?
Yeah.
One thing that I want to highlight over here is that, and I remember that when I was writing my CFA Level 3, I got a question on this.
Okay.
Okay. So I remember that. So basically, even I think in the exam, they most likely ask you to not do many calculations, but to interpret some of the things. So I still remember that मुझे जो question आया था, that was on the risk-free return. Right. So I had to do the simple calculation, and I was able to get the answer. Okay. Is that clear? So can I say that for now, I mean till now, sorry, what we have studied in terms of the formulas. So one we studied was that RDC is being given by 1 plus RFC, 1 plus FX minus 1 is one that we studied. And then the approximation could be RFC plus RFX, right?
Yeah.
It's just the approximation, not the exact one.
Yes, not the exact one.
Right. And then we also studied that in case that there are multiple weights, basically multiple exposures, since returns are additive, so I can always do a sigma of RDC is given by WI RDCI.
Yeah.
Right. Then thirdly, we assume that there is the exposure is only to one of the countries, right? Because if they give you exposure to multiple countries, then the correlation has to be given, which is not can be given in the CFA exam. So if there is only exposure to one currency, then can I say that my sigma square RDC is being given by sigma square RFC, right? Multiply sigma square RFX. So A square plus B square plus 2A B sigma, sorry, correlation between RFC, RFX. Okay? And lastly, only if RFC FC is risk-free rate. Special case, in that case, your sigma RDC is being, look at this, I'm using the word sigma here now. ठीक है, सिग्मा स्क्वायर नहीं है यहाँ पे, और अगर सिग्मा है तो सब कुछ सिग्मा के फॉर्म्स में, और ऑब्वियसली वो अंडर रूट होकर ही वो वाला वैल्यू आती है, ठीक है. So it is going to be RFX multiply 1 plus RFC, and obviously this is a risk-free rate.
Yep.
So far so good.
Yeah.
So currency that you were feeling that it is little difficult, yes, last time. Are you feeling it more confident today?
Yeah. I think last time it was just reaching saturation point. That's why.
I understand. Yeah. Okay. Now, one of the discussion. This is more of a theoretical topic. That there are always people who say that should we hedge the currency or not, right? So a lot of people say that let's not hedge.
Okay.
And some people say let's hedge. So, and these questions can be asked somewhere from the question. Basically, there could be subparts where one of the question is that they give you this much volatility, this much this, and calculate this. And the second part could be the interpretation of that answer, right? And we're gonna talk. We're gonna solve a couple of questions also. But then, before solving, it's important to understand why do people think then that we should not hedge the currency, right? So basically, they say that think about this: if you want to hedge a currency, then you will have to incur some cost.
Yes.
Because you will have to take some offsetting position. If you're gonna go to some futures, etc., then you probably will have to, put some money, the margin, some transaction cost. And if you're getting into a swap, maybe somehow, then even the swap dealers will charge you something, isn't it? Yes or no?
Yes.
Are you following what I'm saying?
Yes. No, I was just trying to compare it to the situation which I told you, the 200 million invested today.
Sorry. Can you speak a little louder?
Yeah, I was just trying to compare it to the example I was giving you, the $200 million today. Suppose I were to hedge it, there'll be a cost to it, right?
Correct. So what I'm trying to say is, let's just use the same example that you have $1 million, right? And you are trying to invest in Indian markets. Now you have two thoughts. First is whether you should hedge versus not hedge. Okay? The currency, obviously.
Yeah.
So one of the things is, what I'm going to tell you is, what if you have 1 million of US dollars and you are investing in in Indian markets, you're trying to hedge, but don't you think that you will have to buy a lot of offsetting transactions, right? And that will also take some time.
Like, what do you mean by offsetting transactions?
So basically, you think that if my USD is going to appreciate, then can I say that my INR is going to depreciate?
Yes.
And my overall return
will go lower.
Is a function of both capital appreciation and my currency return. So, and assuming it's a simple addition, I earned 5% from here and my currency depreciated by 5%, then my net return is 0. Right?
Yeah.
So if I want to ensure that I at least get 5%, so don't you think that I will have to hedge my INR return, which means I have to take some offsetting position so that it offsets what there will be a decrement in the return?
Yes.
Right? So does it not require some cost?
It does, yeah.
Right? Maybe you are entering into some swap contract against some cost.
Yes.
Maybe some futures against some cost. And time. You will obviously have to spend some time understanding that how my market would move. Right? One thing. Second thing is, in a long run, so they say that the currency always reach to a fair value. So basically, if you have a horizon of 5 years, maybe, so if it increases for first 2 years, it will decrease for next 2 years. So we say that the currency usually comes to the fair value. So why do you want to spend some money in a way which has no impact in the long run?
Got it.
Make sense? In the long run, no impact. And third is, although this is not in a book, but I want to mention this, that let's say we are hedging this return, right? But maybe you are too conservative. How about that I can get 10% return on the currency itself? There's an opportunity cost, right?
Yeah.
How about that I can get double my return, one from appreciation, one from the currency. If I'm going to hedge that, I lose out that opportunity of earning from the currency.
Yeah.
Right? So this is a way, this is my reasons of why I should not hedge.
Yeah.
Is that okay? Are we good with that?
Yeah.
Right? But then if everything is in line with that we should not hedge, then why do you think people will still go for hedging? Or maybe do something more about it? So one of the points that they mention is, and which makes sense, that I mentioned that in a long run, there is no impact. But maybe in a short term, there is a huge impact.
Yeah.
And maybe I am not a long-term investor. Maybe I am just trying to invest for only 6 months. While 6 months can have a huge impact on the currency. Right? So they say that assume that I have to hedge and assume that in a short term, the currency can be very much volatile, more than I think. Then what are the different things that I can think of? So one of the things is that they talk about is passive hedging.
Okay.
The name explains, right? You are trying to eliminate the currency risk. ठीक है, मुझे ज़्यादा नहीं आता. I don't know much. I don't want to know much. Maybe there could be a return from the FX. I don't care. Just I don't want anything in terms of FX. ठीक है? And I know that the country in which I'm investing, I can get great returns. Let's say from Africa, where these are frontier markets. So the return from capital appreciation is good enough for me. Let's just eliminate any kind of risk with respect to Forex. Is that okay?
Yeah.
Second is discretionary hedging. Again, the name explains there's some kind of discretion, right? So I can tell, I'm an investor, I can tell my portfolio manager, let's just hedge at least 80% or maybe 90%, right? And so basically 90% kind of passive, kind of, and let's just 10%, let's take a bet.
Oh, so you basically don't hedge the entire notion.
Correct. So you are not hedging the entire exposure to FX. Rather, you are only hedging 90% of it, and 10% you are actively betting. Or maybe you can call it actively betting, or maybe you can call it, let's keep it unhedged. So let's see if that 10% is going to give me more return or less return, but I'm okay with the 10% of volatility. Let's just cover at least 90%. So it's kind of a discretion. Again, 90% is just an example. It's just a way to say that there is some kind of deviation that is possible.
Got it.
Right? And third is active currency management. Again, the name says that you are actively managing. Obviously, the motivation of active currency management is not to reduce risk, but to generate alpha, and which makes sense. The name explains, right? So basically, I'll have more deviations from the benchmark. Is that okay? Clear, not clear? Are you there?
No, I was saying on the active management side, it's 100%, is it? That is unhedged?
So on an active management side, it's not really 100%, but there's much
But
more
more
than the
so.
discretion point,
Yeah. Okay.
right? So
Okay.
the deviation can be higher depending upon how much I think can give me alpha is the amount or the percentage that I'm going to take an active bet on,
Yeah.
right? So could be 100, could be less than 100, but for
Yeah.
sure more than discretionary,
Got it.
right? And the last part on this is a special case which is called as currency overlay. Basically, a currency overlay tells me that I would be using my currency as a different asset class altogether. The assumption is that some of the portfolio managers, they assume that the currency itself is an asset class, and then they invest or they take active bets on as if they are taking active bets on like equities or fixing or some other,
Mm-hmm.
right? So basically, they say that okay, I'm going to take some independent positions, right? And I would be getting more return, and then I can always see whether the position that I took on those currency is going to outperform or underperform depending upon how the market is moving. Right? Again, this currency overlay is even an extension of this much, where my idea is to generate alpha.
Mm.
This is like you can say that this is called as 100% for sure.
Mm.
Okay.
Yeah.
Again, now since I'm using it as an asset class, so my investors can give us a mandate that very similar to the way we give mandates for equities, that okay, I want 10% deviation, or maybe my return expectation is 5% or 10%, or maybe I want absolute return or I want relative return, or of that sort. So I'm saying
Mm.
consider this as an asset class, and whatever we put that in the IPS, you know what
Mm-hmm.
IPS is, right?
Yeah, the investment statement.
Policy statement.
Yeah.
Right? So the way we put everything, and we're going to cover that in some other sessions, right? You mentioned that you want to also talk about this
Yes, yes,
asset
yes.
allocation
Yeah.
in real world constraints. So there I'm going to
Mm.
talk about these things. Okay. So the
Yeah.
point is that the investor is going to tell them that okay, how much exposure do I want in terms of this currency? How much return
Mm.
am I expecting with respect to the benchmark or in terms of absolute terms, and how much
Mm.
volatility that I'm okay with? But then currency is being treated independently as an asset class
That's an
and
asset
would be
class.
given some returns along with the capital appreciation that he can or she can get from the foreign markets,
Mm.
right? So are we okay? Are we okay with why we should not hedge and why we should hedge?
Yeah.
One or two questions here and there is highly likely from this topic,
Got it.
right? Although it's a straightforward topic, but then CFA I think just loves it, so they just ask you one or two questions from it.
Mm.
One point thing is just an extension to what we just discussed is that all of those things, I hope you know, and we will talk about this more, that no matter what a portfolio manager does, no matter, everything has to be documented in IPS.
Mm.
A portfolio manager really can't say that I saw a good opportunity, so I invested.
Mm. Mm.
And this is also one of the best ways to safeguard the portfolio manager, because the investor, they are मतलब उनका कोई धर्म नहीं है in a way that they will always try to blame the manager, right?
Mm.
So they could have said that there was a great IPO DMart, everybody doubled
Yeah.
their money while you didn't invest my money in IPO. Why not?
Yeah.
Even I could have earned. And what you're earning is just shit.
Yeah.
So the IPS is the best way to safeguard that. Look at this, what we agreed upon is this, and this is how I'm investing. I do not see any kind of deviation that is mentioned in the IPS in terms of IPO or in terms of currency management.
Mm.
Right. So why I bring this topic over here, because I'm not trying to teach you IPS, but I'm trying to tell you that if the investor is okay to deviate
Yeah.
the currency risk, then it is very important that it should be explicitly mentioned in the IPS of the target percentage
Mm.
that can be deviated, right? Or maybe you can
Mm.
say the allowable discretion that the manager could have, right?
Yep.
Another important point is what is the frequency of hedging, right?
Yeah.
Because the currencies are volatile every day,
Yes.
and I'm going to talk about this a lot now in some time when I'm going to teach you on dynamic hedging. But the idea is that you hedge some part or you hedge your position, and then you are having a portfolio for 6 months, and then you did the hedging for, let's say, 6 months
Mm-hmm.
or maybe for 3 months. So how frequently do you think that you should hedge, and how volatile the currency market is? And then lastly, what are the different tools that are available? So I'm saying the last one was the hedging tools, right? What are the different tools available? We're going to talk about this as well. But the
Mm.
idea is that how basically when I say that, okay, you can hedge via, let's say, futures,
Mm.
right? It's kind of a hedging tool, right?
Yes.
Or maybe you can get into swap. So what are the different tools that are
Tools you
available
can.
to you? Okay.
Got it.
So the IPS should talk about the target percentage that could be deviated, how much discretion is allowed, what could be the frequency of the hedging, or what are the different tools that are available to hedge. Are we okay so far?
Yeah.
Okay.
So if he's focused on short-term results, he can choose to opt a more sort of active management, active currency management, where he would want to possibly generate alpha.
A client with a USD based portfolio has little need for liquidity. Okay. So this is an important point.
Mm.
And is focused on the short term performance result. Okay. When it says short term, it means I'll have to take some decision. I can't just leave unhedged,
Mm-hmm.
right?
Yeah.
The client evaluates performance relative to a global equity index, which fully hedges currency exposure back to USD and rebalance the monthly hedge. Okay. Discuss how this information would affect the manager's view on hedging the currency exposure in the portfolio. Okay. Then what do you think? The if the manager has a short-term view, right, and he doesn't have any kind of view as in he doesn't have any kind of biasing towards, or maybe doesn't know if the currency is going to increase or decrease, the best solution is to completely hedge, basically passive hedge.
Yeah.
Really, right? But in case
Right.
if he has some kind of a view, if he thinks that he or she can maybe generate some kind of alpha, if not alpha, that the deviation is okay, then he can go for a discretionary hedging where he can deviate a little bit of, or maybe not hedge some part of it while hedge is the most part of it.
Yeah.
So they say discuss how this information would affect the manager's view on hedging the currently exposure in the portfolio, right? So
Yeah.
how this information is going to impact is that in a short term, it's important that I should hedge, and I can go for a monthly hedging, right? But the only thing is, if I don't have any view or if I don't have any take on how we should go about this, so the best way is passive. But if it thinks that, maybe the currency would increase, then they can go for discretionary hedging where, they can passively, let's say, cover 80-90% and keep the 10-20% unhedged.
Yeah.
Is that clear?
Clear.
Also, if one of the options, I don't know if you're going to get something in morning time, but in case you get something in the evening or maybe some question related to it, just ensure that leaving the currency as it is can never be the right answer, is because
his benchmark is hello.
I'm listening to you, yeah, and I'm waiting.
Oh, because his benchmark is completely rebalanced. Is that right? No.
No, look at this. It says it's focused on the short-term performance results,
Oh,
right?
he can't completely leave it.
Sorry?
He can't completely leave it. He can only take advantage
Yeah,
of the short term.
yeah. So I'm saying then when he's focused on short-term results, and we know that in the short term the currency can go up or down,
Yeah.
right? So it is important that he takes at least some decision.
Yeah.
Okay, whether to fully hedge or to have a currency overlay, it's a different thing.
Yeah.
That's a different thing. That depends on the manager. But when it comes to short-term results, I clearly mentioned that in the long run, the currency comes to the fair value. But in the short term, if you are keeping your portfolio unhedged, then you're taking a lot of risk.
Mm-hmm.
Okay. Look at the next one. It says, explain why rebalancing of currency exposure. Rebalancing is basically means, you understand what rebalancing means, right? Could be needed even if no changes are made to asset holdings. Okay. What do you think about this?
Basically, this is to your same last point where you said that, in the short term, he's taking advantage of it. But in the long term, he needs to like adjust and come back to the like fully hedged position that the benchmark has.
Okay. But in that case, you are speaking the opposite. What I got to know from your answer is that he should not rebalance or he should rebalance.
No, he should. So
Right?
if he has a view on the short term
Mm-hmm.
and he slightly deviated away from a full hedge position, he needs to offset that after the short term, right?
Correct, correct.
So therefore, he has to still engage in rebalancing because long term, he needs to have a near perfect hedge.
Right. So the point is, probably I am just adding to your point. Whatever you
Yeah.
said is right, but the idea is that rebalance basically means you take one position initially
Mm-hmm.
and then you change that position. What I'm trying to say is, the word rebalancing means that let's say you have a 60% equity. Just giving you a
Mm-hmm.
general example so that you understand the meaning of rebalancing, and 40% fixed income,
Mm-hmm.
right? And then the market moves and the equity, the overall position of equity will become, let's say, 80, right?
Right.
And the fixed income is still 40, assume.
Mm.
Okay. And when I say that you have to rebalance, it means you will have to sell your equity to a point that it becomes 60.
Yeah.
And you have to put in money in fixed income so that it overall becomes 40% of the portfolio again. So that it
Yeah.
again becomes 60 plus 40. Right? So
Yes.
the point that I'm trying to make is that when rebalance is very important, because in short term, when the volatility is high, even though you took a position initially to offset,
Mm.
even though you took a position initially to offset the exposure, but with time, that might not be 100% immune, maybe in terms of the overall changes in the market. You again have to increase your hedge or decrease your hedge ratio depending upon how your market is moving, because ultimately you are hedging your overall portfolio and the portfolio values keep on increasing or decreasing. Does it make sense? What we have been studying so far is that, let's say you have a notional principal of 1 million and you are taking an offsetting position, but then we always say that this is still going to be 1 million, right, at the end. So we have only one moving part and we hedged that, whatever it would be, let's say currency, let's say something else, but the original amount was always same. But in this case, sorry, since your asset portfolio value is, let's say 1 million, and you took some offsetting position in terms of the currency, when the market is going to move, so when this value also increases, so you will require more contracts to hedge the currency corresponding to that increase in the portfolio value.
Got it.
Does it make sense? So it means it requires constant rebalancing. Rebalancing means that it will require you to buy more contracts or sell more contracts so that you fully hedge your position.
Got it.
Does it make sense now?
Yeah.
That's the reason it says, explain why rebalancing of the currency exposure could be needed if no changes are made to asset holdings. So you are not increasing or decreasing the holdings, but just because of the market, right? The change in the market value will require you to rebalance your exposure.
Yeah.
Is that okay?
Yeah. Can I just see the answer? What they just
look at the first one first.
Oh yeah, okay.
Look at the first one first. So it says there are two possibilities. One is the manager lacks the currency expertise, right? Then the manager should fully hedge the currency risk. And then the second one, if it does have a view, then obviously then they can increase the exposure. Something that we discussed, right? Okay. Look at the next one. It says, sir, suppose that the US client and the index allocate 10% by US equity and sell the GB forward to fully hedge the currency risk. This is like the initial, he takes the initial, initial contract to hedge the currency, right? So I'm saying that no rebalancing happens over here. So this is the initial contract or initial exposure that he got to hedge his currency. Then it says, then over the course of the month, then over the course of something that I said, that from 60 to 40, initially it took it and then it moved to 80-40, let's say. So it says, then over the course of the month, the US stocks in the benchmark fall to some value, while UK stocks rise to some value.
Yeah.
Basically, because of the market movement, I'm just not really dealing with the exact numbers here, but I'm trying to tell you that because of the market, your value could change overall, then the index will reduce the short BB position to reduce, basically to reflect the reduced value.
Yeah.
Right. So the idea is again the same. I give you a general view that if you have an increased exposure because of the market movement, in that case, you will also have to increase your exposure, or basically to say to increase your hedge, and reverse is also true.
Yeah.
Clear?
Yep.
Or any doubts?
No, clear.
ठीक है, तो ध्यान रखना कि जो रीबैलेंसिंग कॉन्सेप्ट है वो एक बार अपनी पोजीशन को हेज करने के बाद वो बाद में चेंज करने के बारे में रीबैलेंसिंग कहते हैं. ठीक है, तो यहाँ पे देखो, he fully hedged the currency risk and then over the course of action whatever has happened he's again going to do that.
Yeah, awesome.
Okay.
Yeah,
there are a few.
We'll call it a day. Like we can extend maybe by like 15 minutes tomorrow if that's okay.
Okay, I'm just saying, which this is just the end of the topic, right? It just take 3-4 more minutes. Is it too heavy of class today?
No, I'm just extremely exhausted, so that's why.
Okay,
Thank-
just
And I have a call after this, so I just
अच्छा
wanted a
चलो ठीक
breather.
है ठीक है ठीक है ठीक है ठीक है. There are just a few points here and there, but we'll cover that
No
tomorrow.
worries.
Probably it's just going to be helpful.
Thank you for
Maybe.
understanding. Yeah.
Yeah, that's fine. But I'm saying I think this is also going to be helpful tomorrow because this is like the summary of what we discussed.
Okay.
So
Yeah.
this
Yeah,
will
let's do it.
work as a refresher tomorrow morning.
Okay. Okay. Thank you.
Right? So I'll see you at 7 then tomorrow.
7. Yeah.
7
7
to
makes
10,
sense.
okay?
Yeah. Perfect.
And one just one last thing. So 7 to 10 tomorrow, and then Sunday will be off, and then again Monday would be off, and then I'll see you on Tuesday. Is that correct?
Yeah. I can let you know. See, I have like this some case study interview. So depending on how taxing that is, maybe I'll get it today sometime. So I can see if I can try and do Sunday because I'm aware that you're traveling. Um.
No, it's fine. If
So
Sunday is not doable, that's fine.
yeah,
But
yeah,
then
yeah.
I'm saying Monday will never be the class, right? I understand that. Is that
Yeah,
correct? Oh,
that's
Monday you have
because
a call,
that
right? Monday mornings.
8:30 call. I have
Okay.
that 8:30
So
call. That's the issue.
most likely by after
And what
tomorrow
we
it's
can
going to
do
be
is,
Tuesday then. Mhm.
yeah, what we can do is maybe we can Tuesday we can do like 7 to 9:30, something like that. Maybe we can extend more.
Okay. All right. We will see that tomorrow. At least let's
All
just
right.
call it a day today.
Yeah.
Okay. But
Okay.
Gaurav, just again asking, in today's class, is there anything that you couldn't understand overall?
No, no, no. I think I understood everything.
Okay, perfect. Cool. Then I'll see you tomorrow then morning.
Thank you.
All right.
Bye.
Thank you, Gaurav. Bye.